Your bank account can't do this. Your brokerage account can't do this. No other account can do this. You're earning uninterrupted compound interest on all of your money, and you're still able to use that money to go out there and lend it, to pay off debts, to buy stocks, to buy real estate, to buy cars, to buy boats, to invest in alternative investments, or hell, just to start your own company like I did with Private Money Club. Doesn't matter what you use it for. These are all opportunities. I just picked on lending. Welcome back, everybody, to another episode of Wealth Webinar. Appreciate all of you being here. We respect your time. Your time is the most valuable thing that you have to give. So you're spending it with us, and we very much appreciate that. I'm joined here with my partner in crime, Mr. Snaggy. Is that the right way? Nope, that way. What's up? Head backwards.
Hey, good afternoon. Yeah, just coming off hot from the 3-day weekend, 3-day Money School Essentials training this weekend. Was anybody on? I thought it was awesome. I've gotten a bunch of really good feedback and emails from it. A lot of people taking action and getting things started. So looking forward to today and keeping the education and the strategies rolling, Chris. It's gonna be good.
Awesome. So one of the cool things, I mean, I think, and I say this every time, so it's really cliche. Every time we do the 3-day training, I always say it's the best one we ever did. And maybe it's because it's the best one we ever did for that particular time frame. All of our 3-day trainings are always designed and custom done for exactly that. What's happening now. It'd be one thing if we just did the same 3-day over and over and you learned the same things, but you would never have new people showing up because it would just get boring. And we don't do that. But I think a couple things that we did on the 3-day were really important. And we also launched something that we'd been working on for about 4 months. We launched it there. It was the first time we'd ever announced it. We're going to do the same thing here. We're going to announce, something that all of you can take advantage of, something we've worked very hard at. And this thing that we worked really hard at that you're all going to hear about today is something you were all asking us for. We didn't just work hard on something. Oh my God, we thought this would be great. Let's build it. Let's spend 4 months creating it. And then let's hope everybody likes it. We already knew all of you would like it because you all asked for it. It's just something that we had to spend a lot of time to get right, get the right people, and then perfect it. And that's what we did. And we launched this weekend. A bunch of people took advantage of that. You're now going to hear about that. We'll probably announce that a little bit later. But it's important that we kind of walk into the important things. So real quick, I just want to make sure that I've got the right material for all of you and what you're looking for. So the first thing, how many of you would like to make 12 to 15% interest on your money without ever having to go into your principal? And actually, then let me ask you, is anyone on here making 12 to 15% on your money? And if you are, just put the percentage that you're making right now. So everybody, wanted to watch it, but I'm sure some of you are making that, right? Anyone making 12 to 15%? Okay, there we go. What is QYLD, Matthew? Would like to know what that is. 14%, Ruth. Aaron, 12%. Who else? There's got to be some more people making 12, 15, maybe even more. If you're making more, just put the number. What are you making? Julie's making 12. Okay, covered call ETF. Nice. 15, Maureen. Tabitha, 12. Only 4%. Martha's going to love today. What else? 12%, Julie. It's kind of interesting. Like I'm just looking at the names as this comes in. And I can almost see the pattern, all the people that you saw, and some of you, like this isn't planned, this isn't staged, folks. We don't know who's on here, and numbers are going to keep climbing. But it's a simple question. Would you like to make 12 to 15%? Well, I'm not here to say, there's some get rich quick thing, but you just saw, I asked, and people said that's what they're making. 12% for Deborah. Julie said also have a few others that are higher but smaller amounts. Okay, great. Now, how many of you are losing money right now? And you don't need to put the negative number unless you want to. How many of you are losing money on your investments right now? Put I in the chat or put the negative number that you're making. And I bet you once we start seeing some of these, I could piece together exactly the similarities to all of them. So Chris and Martha, really only a couple of people losing money? Have we done that good of a job of training everybody on here? One tenant not paying rent, that sucks. 401k down. Well, down a bit right now, Tabitha, is really good. Most 401ks are down over 20%. So if you're only down a bit, losing to inflation, Rod. So I'll show you how to beat that. Inflation's easy. Inflation's it's a real thing, but it's been around. It's always been there. Yes, is it high? And also, folks, anyone. So Sam, thank you, Sam, for being honest, and thank you, Matthew. Matthew said it. I'm down almost 40% on my 401ks. Probably heavy tech. A lot of tech companies would drive you down 40%. Sam being down 20%, probably in index funds or maybe freedom date funds or target date funds. Yep, Becky said 401ks gone with COVID. Losing to a bad tenant, yeah, that's tough. And unfortunately, there's just always going to be bad tenants. Set out this Friday. Good. All right. So here's the thing, like when you look at that and you really kind of just dissect some of that data that just came in from people. I mean, everybody, that was making money, you notice how the similarities in the numbers, and I kind of staged that because I said 12 to 15, but they could have put any number that they wanted. But did you notice how many of them had the same returns they were making? And then did you notice when I asked, who was losing money? And, some people were kind enough to share the negative number. And if you don't want to, I totally get it. It's sometimes it's not a badge that you want to wear, to be proud, but it is a badge. It is something that is important for you to acknowledge because it's a learning lesson. Some people are like, oh my God, I'm down. I don't want anyone to know that. Why? This is how you learn. And you being here is exactly that. It's a learning webinar. This is where you're going to learn how to change the tides. So most of the people that were down have followed traditional financial advice. Most of the people that were down have kind of just gone about things where they've done what their parents told them, what their grandparents told them, what their financial advisor, not putting them under the bus, but they've just followed traditional financial advice. And most of that traditional financial advice, as you saw, 401ks. Okay, there was a couple that were losing money because of bad tenants. That's what it is, but you can also work around that. You don't have to own the property to make the returns, and we'll talk about that. But you do see the similarities. Some people were making money and some people were losing money. And there was one very simple thing in the middle that separated those two. And that is what we're going to talk about today. We're going to talk about something that I talk about it all the time. And sometimes, I almost don't want to talk about it, but we're going to talk about just applying some basic principles to what you do day in and day out. And here's what you can expect. Okay. So there's nothing crazy complicated about what we do. There's nothing complicated at all about what those folks that you just saw posting 12, 14, 15 and percent gains. There's nothing hard about what they were doing at all. They literally just changed a few simple things, learned a few simple things, maybe got mentored, maybe got coached, or maybe just self-taught themselves how to do something that has been around for probably, if I'm not mistaken, just the other day, 300 years, I think is what somebody had mentioned. And that is banking. Yeah, that's right. Banking. I know some of you are like, well, that's boring. Yeah, it is boring. But what's not boring is making 12%, 14% on your money when everybody else is losing. And other people that are following traditional advice, giving up control of their money to, Wall Street, to 401ks, to bank accounts, where they're, and I love that I can't remember who it was, but the person that said they're losing to inflation. Of course you are, if you're giving up control and leaving money sitting in a bank account. And just so you all know, that's the majority of the people out there. They don't know what to do with their money when the markets start falling apart like they are, when news of recession starts coming out and people start really realizing that we're going to be in a recession here very soon. Oh, by the way, we're already in a recession technically speaking, but they're saying we're going into a recession, whichever way you believe it, and that scares people. So people do what's called the flight to safety. They look for a safe place to put their money. And what's the safest place to put your money? So anyone, what's just the audience real quick? We got about 140 on. What's the safest place you know of where you can put your money? Todd, if you're breaking even, you're not doing too bad. All things considered right now. I'm not saying that's good. And I'll show you how to not just break even, but where else is everybody like, for some of you how many of you are first timers here? Put I in the chat. Hey, we got any first timers? So Todd, that's interesting. You said a trust. A trust is not a safe place to put your money. A trust just protects you against liability. Inside the trust, you have to put your money in something. So right there, somebody just said at a bank. Inside of a trust, yes, you can protect yourself from liability and maybe some tax, stuff like that. But Todd, in a trust, you have to have the money in something in a trust. And most people would say the safe place to have it is a bank. And I love that Martha said bank. Okay. She then kind of let the cat out of the bag, but safe at home. I love that. Dexter said safe at home. So we got a lot of people saying that 20-year military pension. Yeah, Michael, that's a safe income, but I didn't ask about incomes. I asked about when you get that safe income, Michael Coco, where does that safe 20-year military pension go? That's what I was asking. Like the mattress for now, that's funny, Andy. But it's not really funny because back during the Great Depression, that's exactly what people did. They put their money in the walls. They put their money in their mattress because it was safer than the bank. It was safer than anywhere else they could put it. So it's kind of funny that Andy said that, because is that really where people are thinking right now, that the mattress is the safe place for your money? Okay, and then Tabitha said investments. I'd like to quantify investments a little bit, self-directed. So, all right, so we got a bunch of answers. But really, at the end of the day, we've all been taught when we make money, we've been taught to put that money into a traditional bank. And that is what we've mostly done. And then from the traditional bank, we have gone out and tried to find, places where we can make a better return. And we've landed in things like mutual funds and ETFs and stocks and maybe bonds. And some of you mentioned real estate and Forex and options. But you found all these different things. And every one of you have found a different path, because hopefully, and write this down if you don't know this, the only thing that you should have found to put your money in are things that you know, like, and understand. So those that said real estate, I hope you know, like, and understand real estate. Those of you that said Forex, I hope you know, like, and understand Forex. And in whatever investment you're putting the money in, you must know, like, and understand that investment. Because if you're not, you're putting yourself in something that is it's irresponsible to put your money in something you don't understand, something you don't like, and something you truly have no knowledge of. And that's what happened to a lot of people that put money in FTX. And what happened to a lot of people that put money in those meme coins or those crypto investments, where they knew nothing about it except for somebody told them that they were going to make a lot of money, or somewhere through the grapevine they heard that, oh, we're going to get rich quick, we're going to make millions of dollars. Some did, but they only did if they got out. And that's the biggest problem. Most people, when they invest in something, they never have a game plan. They never have a set of rules for when they're going to exit. And if you don't have a set of rules for when you're going to exit, well, eventually it's just a matter of time before you do lose money. I mean, it's just the nature of the beast. So what I really thought we would talk about today, given what's happening, and folks, if you haven't paid attention to the news, just today, we got the news that inflation, which is supposed to be going down, right? It has been going down, right? Woo! Market rallies, the Fed's doing their job. They're raising interest rates. They're pulling money out of the market through unwinding their balance sheet, and they're getting a hold of that dragon, that inflation monster. By the way, folks, they created it, but we won't let anybody else know that. So inflation was going down until today. Inflation went back up 0.5%. Is that correct, Stephen? 0.5% CPI? Yep. So we gained 0.5% in inflation. Now, all of you know that's the wrong direction, right? That's that direction. That means that eggs might get more expensive. That means that milk could get more expensive. Those cars and the clothes and everything, salad, is going to get more expensive because of inflation. But that's one side. The other side, and what scares the market and why the market's down pretty big numbers today, and has been pretty much all week in anticipation of these CPI reports, is that means the Fed, okay, the Dragon Slayer, is going to continue to fight the battle against inflation. What does that continued battle look like? More rate increases. That's right. Interest rates will continue to go higher, and they will continue to unwind their balance sheet at the tune of, I don't know where they're at, 90 billion a month or something like that. It's a lot. And they'll just continue on this path. So I know that Congress, in their almighty power, sent a letter to the Fed. We played this on one of the trainings we did. It was a letter to the Fed where they literally were kind of begging Jerome Powell and the Fed not to continue raising interest rates at these alarming rates because you're hurting the taxpayers. But the Fed kind of just ignored it and said, hey, listen, okay, we won't raise rates at 0.75 or 0.5, and they dropped them to 0.25, and the market rallied. They didn't say they were going to stop raising rates. And the data that came out today solidifies that they absolutely are not going to stop raising interest rates. So the next time they raise rates, you could probably expect 25 to 0.5% increase. They're going to continue to keep doing that until they get to their target of 2%. And unfortunately, they're going the wrong direction. Now, I read a lot of white papers, and in these white papers I read, they told me, they kind of anticipated that this was going to happen. We're going to be in a long, high inflation period. So in other words, we're going to be in this high inflation world for quite some time, which means when you're in a high inflation period, and things are going down and you have deflation going on, you are in what's essentially known as stagflation. There's a little more to that, but it's a terrible place to be. Japan can tell you all about it. For 10 years, they lived in stagflation. Awful way for for us Americans to have to live in this economy of stagflation. Now, hopefully we don't, but I'm just saying, like, it's getting closer and closer, especially with inflation going up. But when the rates go up, you know what else it's not good for? Stock market. So stock market keeps going down. And anybody that invests in traditional places invests with their financial advisors, because they really only have, like, you might think your financial advisor's got this big bag of tricks, like these big bag of things that they can put your money in. Most of them only use the same things, and they constantly continue to use the same things over and over and over and over again, expecting different results, and they don't get different results. They get the same results, just spun a different way. And that's something I remember as an advisor of 16 years. I remember that same thing. It was like, hey, that's what we did last time, and that didn't really work. Yeah, well, it'll work this time. And then it didn't. And then they're like, oh, all right, well, we're going to do this. So the whole thing I want to show you today is I want to show you a place where you can put your money. Most of you already know of it. You already said it. You know, it's, let me get the cat out of the bag right now. It's a specially designed and engineered whole life. That's right. Some of you are like, oh my God, no way. I did not come on this training to learn about a specially designed whole life. Dave Ramsey, Susie Orman, and all of them said that that's a terrible place. And that's not what I'm here for. I want to learn how to make real money. Great. You already heard a bunch of people making 12, 15%. They're not losing right now like everybody else. They're making. You know how they're making money? They are being the bank. Oh, well, Chris, I don't know what that means. I just keep seeing your hat, BYOB, and Steven's hat, BYOB. Like, what does that mean? That means you do what a bank does every day. That means you treat your money the same way you treat the bank's money. That means you take back the banking functions in your life. So what I want to do is show you how that looks, what it looks like. And I really wanted to then give you a path, a clear path of hand-holding that will literally show you how to do exactly the same thing all those people were doing, at least that I think they were doing, that were making 14 and 12 and 15 and higher percentages. I'm going to show you how not to do what the folks were doing with their 401ks where they were losing money. And I'm going to show you how to jump over to the other side, how to have your money in a place that has security. And what I mean by security is there's something backing your money. You've never gone to a bank, or in most cases, I mean, credit cards, yeah, but you've usually not gone to a bank and borrowed money where the bank was left in an unsecured position. Think about that. All the loans you've taken out. How many of you have taken out a car loan? I'm sure most of you have taken a car loan, right? Or leased a car at least. Yeah, so got a bunch of cars coming in. So if you've leased a car, you've bought a car, when the bank gave you the money for that car, you ignored a lot of the things that were going on behind the scene because you were just looking at that new shiny automobile and you couldn't wait to get it off that showroom floor and drive it home. But what was going on behind the scenes is the bank that was giving you the money to buy that car was putting together paperwork. One was a note, okay, stating the terms of how they were going to give you the money. And the second was a lien, like basically putting a lien on the vehicle, meaning, all right, we're going to give you the money to buy this car, but we're technically going to own the car if you don't pay us. So we give you the money, and what you're going to give us is you're going to give us payments every month. Those payments are going to include interest and principal, leases too. Yes, folks, leases have interest baked into them. Interest and principal, you're going to pay that to us. We're going to give you the money to buy the car, and then we're going to make sure that you pay us because we're going to put a lien on the title, which means you can never sell this car. And if you stop paying us, we're going to send a tow truck in the middle of the night, and in the morning, you're not going to have a car because we're going to take the car back. They're secured. Same thing with houses, and we could go down the line. Boats, anything you've bought, usually there's security. And if it's not a tangible asset, what have you secured it with? A personal guarantee. Heck, you probably personally guaranteed even the things that you secured with a tangible asset. So then, if you don't pay the bank just goes after your personal assets, freezes your bank accounts. Don't think that's real? Oh, I'm sure somebody on here has had this happen in the past. They freeze your bank accounts until you pay them. They garnish your wages until you pay them. How many of you want to put your money where the bank does, where there's a secured asset backing it, or a personal guarantee that you can then take their assets, garnish their wages? Okay, all those things. Of course you do. Or, well, I mean, some of you maybe just want to put money in the stock market where there is no tangible asset, there is no lien, and you ain't taking nothing when the stock goes down to zero. I mean, 2008, a lot of people learned that the hard way with Lehman's. Like, you don't get anything. There's no security. It's just like, all right, well, sorry guys, we screwed up. Okay, people that, FTX wasn't publicly traded, but sure there was investors, and those investors are like, well, that was a bad bet. You don't want to be the bad bet. You don't want to put yourself in that situation. You want to be the bank, because that's what banks have done for hundreds of years, over 300 years in their existence, and they've figured it out. So why don't we just copy that, right? So if I may, and actually, Stephen, real quick, I'm going to show a slide. Although some of you have seen this, but this is very simple. I just want to run you through an exercise, so play along. How many of you on here own a restaurant or have ever owned a restaurant? Anyone? All right, so James, perfect. I'm going to pick on James Davidson. James, when you own a restaurant, do you bring your friends to your restaurant to wine and dine them? Do you bring clients or people that you're trying to impress? Or if you do an event, do you bring them to your restaurant, or do you bring them to your competitor's restaurant? And I'm just asking James because he's got a restaurant. Sure, all the time. Brings people to his restaurant. I went out for Valentine's Day to my favorite restaurant called YOLO. My buddy Justin owns it. And guess what? Justin was at the restaurant. Justin was greeting customers, and Justin was sitting down with his 2 little boys and his wife eating dinner. Pretty common, right? Like you're all like, oh, well, yeah, duh. He owns the restaurant, so why wouldn't he dine at his restaurant? Okay, next round. If any of you owned a salon, like primarily the women, if you owned a salon, would you get your hair done in your salon, or would you go to a competitor's salon? You would never want your customers seeing you across the street at a competitor's salon. Can you imagine having to have that discussion? Susie, did I see you over across the street getting your nails done at the salon? Don't you guys do nails here? Yeah. And what would be your excuse? Oh, I was just checking out the competition. That still isn't going to go over well with your customers. You would absolutely get your hair done, get your nails done, get all your services done at your salon. Gyms. I was at the gym this morning, and guess who I saw at the gym? You'd never believe this. No, it wasn't Sylvester Stallone. No, Arnold wasn't there either. Sorry. Yeah, it was the gym owner. His name's Justin. 2 Justins. But he was at the gym, and he was working with a client. He was doing some training with him. I said, hey, what's up? And he said, hi. And every single time I go to the gym, guess what? I see him or his wife every time. Now, I've gone to other gyms, and I've never seen Justin or his wife at another gym. Do you know why? Because they own the gym. They want to be seen in their gym. Of course, they're going to work out in their gym. They want their customers to know that they're there. Okay, so we all can kind of relate to that. Oh, Denise, yeah, you went to YOLO with your son, James? That's awesome. I love it. Last question. See the big one up there? What is that? It's a bank, a traditional bank. You've all seen ones that look similar to that. That might be a little older school bank, but it's pretty. So if you owned that bank, would you make deposits in your bank, or would you go to Bank of America across the street? You'd make deposits in your bank. And if you needed a car loan for that new car you're going to buy, would you take the loan from your bank shown there, the one that had your name on the front, or would you go to Bank of America and say, oh, Bank of America had a slightly lower rate, so I went across the street and I got a loan from their bank? Heck no. You'd go right to your bank, and maybe you'd, match the rate or whatever. But you would never, ever be caught dead depositing money or taking loans from somebody else's bank if your name was on the bank. And when you took a loan from your bank for that car, would you set up monthly payments back to your bank? Of course you would. You'd have to. It's not your money. The bank, in that case, you'd be using other people's money, your depositors, your customers' money. But even if it was your money, would you pay your bank back because that's the business you're in? Absolutely. You would never steal from your bank, because if you stole from your bank eventually would go out of business. Because if you were stealing and your customers found out that the owner of the bank took a loan out and was stealing money from the bank by not paying it back, well, then they would start doing the same thing. It's like follow the leader. And you see it every single day. Oh my God, everybody ran and jumped into FTX. Everybody ran and jumped into, Shiba Inu, if you guys ever remember that crypto. They ran and jumped into that, and they just followed the herd, because that's just human nature. So because of that, we all can agree that you would never steal from your own bank. You would make deposits in your own bank. You would take loans from your own bank, and you would treat your bank's money the same exact way you would have treated Bank of America's money before you owned a bank. Is that true? I'm just asking. Deborah said, of course. So anyone else think that's true? Is that how you would handle your bank's money? I want to make sure, because listen, like if you would all steal from your bank, well, then I'm going to train you on something else. I'm not going to teach you what I'm about to teach you. Respect those rules and treat your bank better, right? Yeah. Okay. Derek said, yep. Okay. Overcharge yourself interest when possible. I like that. James Davidson said he'd overcharge himself if he could, right? If he had the money to pay a little bit more to his bank, he would. Because at the end of the day, let me ask you this question. If you owned the bank and you made monthly payments to your bank, and those monthly payments were interest and principal, at the end of the day, who gets the interest? The profit? You do, because you own the bank. So I love what James said. He said he'd overcharge himself interest. If he had the ability to make that payment, you know, he had the income to pay that payment, he'd overcharge himself, because at the end of the day, it wouldn't matter. He'd get all the money. One more thing, because I'm trying to wrap your head around this. So much of what we teach plays into this one statement, and you've all seen this and probably heard about this. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Okay, so let me test your knowledge on this. How many of you have heard of Will Rogers? Let's just go back to many years ago. You all know who Warren Buffett is, right? Very wealthy man, one of the wealthiest men in the world. But he's got a buddy, Bill Gates, who's also one of the wealthiest men in the world. And these guys spend time together, like they speak at conferences together, they chat, maybe they go out for, you know, cherry Coca-Colas from time to time, and maybe a burger, you know, Warren Buffett's favorites. But if you recall, Warren Buffett went public with this great deed he was going to do for humanity. And he said, I'm going to give my entire net worth up. I'm going to literally give it away. I'm going to put it into a charity. And that charity is called the Gates Foundation. And the Gates Foundation is going to do great things, solve world problems. And Gates Foundation does. They do good things. They have to. They're a charity. Okay. And we all said, oh my God, Warren's such a good guy. And oh, wow, Warren, I can't believe he's given up everything he made. Who would do that? Who would give up all their money? Like, you're probably thinking about that and you're like, man, Warren worked hard for that. We just gave it all away. Let me go back to Will Rogers. The problem in America isn't so much what people don't know. The problem is what people think they know that just ain't so. So the people that thought, oh, what a nice guy. Oh my God, he's given up all his wealth. Why would he do that? Those are the people that think they know what just ain't so. Because let me sum up what really happened. Warren Buffett did give up and write a check for his, you know, his net worth, that billions of dollars, that tens of billions of dollars, or whatever the number was. I can't remember. If anyone knows what the number was, remind me. Was it 80 billion? Or maybe not that much. I don't know. It was a lot. And he did write a check to the Gates Foundation. And for doing that awesome charitable donation, he got a full tax write-off of all that money. That's right, a tax write-off that he could then carry over year after year if he wanted to. Awesome. So, hey, give the guy a tax write-off, man. He just did a great thing and going to solve a lot of that. You're right, Chris. He didn't really give up half his fortune. Here's what he did. He did write the check to the Gates Foundation. Now, because Gates and Warren are good friends, Warren at some point or another had told Bill Gates about his awesome fund called Berkshire and Hathaway. And, you know, Gates probably did some research or had his team do some research on this fund that Warren created called Berkshire Hathaway, and found out, wow, this is a really great investment. Warren, look at the returns. You've beat the market almost every year. You've outperformed. Like, how have you done this? And Warren's like, well, I can't tell you. I'd have to kill you. But I'm just joking. So he did this, and Gates, Bill Gates, being the founder of the Gates Foundation and the sole person who controls where the funds in the Gates Foundation are invested, said, well, this is a really good one. We've done our due diligence. We're going to invest Warren's contribution into this awesome investment called Berkshire Hathaway. So when Gates got Warren's money, he invested it in Warren's fund, Berkshire Hathaway. Nothing wrong with that. He did the right thing. He did his due diligence. It's a good investment. It's going to make a return. And the return that he makes inside the foundation allows him to do more really amazing things and solve world problems and world hunger and a lot of other things. We're just going to leave that alone. Does everybody understand what just happened? Because the problem in America isn't so much what you don't know, because what you don't know is what just probably happened there. The problem is you think you know what just ain't so. You think that Warren just did a really good deed, which he did, and he really just gave up all of his net worth. Warren didn't give up anything. He wrote the check. The money all made its way back into Warren's fund, and Warren makes the money on the fund, drives an income off the fund, drives the Volkswagen Beetle paid by the money he derives off of the fund. You get the drift. He was still in control of the fund and still in control of all of his money because Gates did a good thing and invested Warren's money so that it could grow. Does everybody understand that? The exact same thing could be said for all of you. It really could, because all of you technically have the ability to do the same thing. You could put your money in your own banking system, and everything that you do with that money to invest it, all the returns and everything would always come back to your bank and be in your control. It's the same kind of thing. It's brilliant, right? Warren didn't take a salary. You're probably right, Andy. I forget about the salary and the Beetle. He just paid cash for the Beetle. He didn't need the salary. But regardless, I mean, Warren, all of you know, is a very wealthy individual, whether he's taking a salary from Berkshire or not, or anything. That's semantics. All right. So let's get into this, because all I want to do is I want to talk you through what we're going to mention here and how this whole thing works. Because a lot of people earlier, when I asked them where a safe place to put their money was, they all said whole life or IBC or something like that. And IBC and the whole life are two separate things. I want everybody to be clear. The whole life, okay, is just a product. It's just a product that you put your money in. You might even think of that product as being a piece of crap product. You might think of that as being an overpriced life insurance policy, a policy where only person making any money, says Dave Ramsey, is the person who sold you that piece of crap whole life, right? I'm being correct. So that's the whole life, which we'll get to in a second. But the second part of it is IBC, infinite banking concept, pioneered and created by the late R. Nelson Nash. And IBC is a process represented here by a circle. And that's all you need to know. It's a circle. So in order to use the whole life and the process, all you need to do is change one thing, and that's where your money goes first. That's all you really need to do. But why first would you ever put your money in a whole life? I mean, can anyone tell me why you'd put your money in a whole life insurance policy? Or you could even tell me why you wouldn't put your money in a whole life policy. That would actually be more beneficial. Tax-free growth, that is correct. It is tax-free if built correct. Compound interest, that is correct. Aside from the death benefit, control and liquidity, that is correct. Come on, there's got to be some people on here. Is there any newbies on here today? Got 140 people. There's got to be some new folks on here. Guaranteed compound interest, tax-free. I'm getting all the good stuff. Where's the bad stuff? Why would you not put your, Tabitha said, not smart, like it. My husband thinks it's a scam, right? Oldest scam in the world. I was new 2 to 3 years ago, cash value. Why not though? Why no access right there? Not access. I love that. Not access to 100% up front. Your wife says it's a terrible idea. An investment. She's right though. Matt, your wife is absolutely correct. It's not an investment at all. So she is right. It's a terrible idea for an investment because it's not an investment. My husband did too. Luckily, I'm in charge. I love it, Eve. So we didn't really have I thought there was going to be more people that would say negative things, but all the negative things they just said were all correct. You don't have access to all your money in the first year when you put it into that whole life policy. And, you know, people think that it's a scam, which is awesome because it's the oldest scam in the world. Oh, yes. Sonia said, oh, you got to pay to use your money. You got to pay interest on that money. But you all just said if you owned your own bank, you'd pay yourself your bank back with interest and principal. Did you not? You all said that. And you were all thinking, yeah, if I owned that bank, I'd pay it back with interest. And why would that be? Well, it'd be because you owned the bank and you wouldn't steal from your bank. So now let me explain. It's expensive. I love that. Deborah Brick said whole life is expensive. But when you say it's expensive, you got to quantify that. What's expensive about a whole life? One thing, the death benefit, because that's what you're buying. In a whole life insurance policy or in life insurance in general, what are you paying for? You're paying for a future death benefit when you die, a death benefit that will be paid out to your beneficiaries, a death benefit that will allow your beneficiaries to live a better life, have an income, maintain the household that you have, maintain the standard of living you have. That's what you're paying for. But oh yeah, but Chris, in a whole life, that death benefit's really, really expensive. Oh, I know. It is super expensive. It's the most expensive life insurance policy you could ever buy. And a regular whole life policy used to, you know, it pays a really big commission, but not the biggest anymore. IULs are the highest commissions paid on life insurance. But yes, you're paying for a death benefit. So what does Dave Ramsey tell us to do? If you don't want to pay for that overpriced whole life policy that doesn't give you access to all of your money, that's a scam, and that my wife says is a terrible place to put your money, then what would you buy if you wanted to protect your family because you love your family and your children? You'd buy term insurance. Exactly, Deborah. You'd buy term. I fully agree. And why would you buy term? Well, you buy term because it's cheap, because it's low cost, because you need the death benefit, but you don't want to pay all that expensive whole life. So are we all on the same page? Like, why would you ever pay for death benefit in a whole life because it's overpriced and expensive? You wouldn't. You'd just buy term insurance. And I'm sitting here really from the driver's seat here saying, I agree with you. And I also am agreeing that, you know, you got to pay interest on the money when you take it out. Yeah, you do. The insurance company, those greedy jerks, they're going to charge you interest on the money that you take from your policy. Oh, who would want to do that? It's my money. When I put money in the bank, I don't have to pay the bank interest to take my own money, do I? No, you don't. No, it's a beautiful thing. And when I put my money in the bank account, I get to take all of my money out. Oh, yes, yes, you do. Yes, indeed. All of your money except for any interest that you made that was taxed, right? Yeah. You get to take all that minus taxes. Here's the part you're not acknowledging. If you put your money in a traditional bank, you're barely making any interest anyway. Okay. So you're really not growing that money. It's just sitting there. And then the bank is taking that money, and the bank is making that money go to work for them. They're lending it out. They're lending it out. They're making interest in principals. They're making more than what they're paying you. If the bank today, if you find a bank that pays you 3%, how much, if you put your money in that bank because you love it, they're paying you 3%, that'd be a good rate. And you wanted to take a car loan from that same bank, and you had all the money in the bank to pay cash for the car, but you're like, no, 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 they're going to give me a loan. How much would they charge you? Minimum 6, and good luck finding a 6% car loan. That's double, right? So if they pay you 3 and they charge you 6, what did they make in the middle? Make a spread. So now let's get into this. The whole life policy that I'm going to talk to you about is not the one that you just mentioned. It is not the same whole life that you have been told was a scam, that you have been told is, overpriced, and that it is at its core, but you see, it's designed and engineered backwards. It's designed and engineered to do something different. And in other words, we're going to design it and engineer it to have the lowest whole life death benefit we can put on the policy. Why? Because why pay the insurance company that expensive whole life that is, from, the whole life insurance? You all said it's expensive. So what we're going to do is we're going to design it backwards. But once we put our money in there, what you don't know, any of you that have never heard this, what you don't know, and I'm going to use some numbers just because this is the example I have. And folks, if this is a big number to you, please just make it any number you want. I'm just doing this as an example. So when we talk about the infinite banking concept and becoming your own bank, we talk about one change, adding one step to what you do. And that is where your money goes first. Notice I didn't say where your money goes last. I said where your money goes first. In other words, we're going to put our money in this machine, the whole life policy, first. But that doesn't mean that's where the money is going to stay. So if we put our money in there, and I'm just going to use an example of somebody that had $500,000 from the sale of a piece of real estate that they just sold. And that money was just sitting after the sale of that real estate, sitting in their bank account. Okay, it's just sitting there. And they were looking for a better return on that $500,000. So they did some research, and they found out that whole life insurance pays a guaranteed interest rate, and they found a company that pays 3.25%. And then they found out that that same company that guarantees them 3.25% for the rest of their life contractually, not like a bank, because you can find banks paying 3.25% right now. Ally Bank, I think, is paying that. You might even be able to find banks that pay higher than that. But it isn't guaranteed till the day you die. Mark my words. They pay that interest rate today because the Fed keeps raising interest rate. The second the Fed drops rates, you're going to be back down to close to zero where you were before. Secondarily, they found out, this person that had that $500,000 windfall from the sale of the property, they found out that this insurance company, which is a giant mutually owned insurance company that's been around, I think in excess of 140 years, if I'm getting it right, they also pay dividends every year, and they have paid dividends every single year for well over 100 years. They've never missed a dividend, from the research that this person found. So they're like, well, hold on a second. If I got 500,000 sitting in the bank, and the most the bank's going to pay me is 3, but I know that that's short-lived, and I can just change where that money goes. I can put it into a specially designed and specially engineered whole life policy. That insurance company is going to pay me 3.25 plus a dividend, which gets me anywhere around 5.2 to 6%. I'm just doing a range, okay, depending on when we look at it, because dividends are not guaranteed and they can change. Right now, they're probably on the move up because of interest rates. So the combination, I'm going to make between 5.2 and 6%. All right, well, sign me up. That's way better than what the bank gives me. And then they found out, they did some research on the IRS code, and they found out that life insurance and its internal buildup of cash value, which is this interest rate that you're earning, that internal buildup is tax-free. So this person says, well, all right, I got 500 grand. I'm going to earn interest on this money and dividends. If I don't have to pay tax, why would I? Great. So I'm going to put it in here. So they do that. They put 500,000 into this specially designed and engineered whole life. Now, let's just say that this person, and I want to quantify and make this person real. It's a 47-year-old female that sold her real estate deal and had a windfall of 500 grand. But she also manages other real estate. She has a business that is in real estate, and she makes income. And every year she saves roughly about $50,000. And she wants to be able to put anywhere between 25 to 50, 25 minimum to 50,000 into this every year, because she was saving 25 to 50 grand every year in a regular bank. And she said, well, I want to put my money where it earns a higher rate and where it's more secured. So she puts it in here. All right. Now that's the first step. She changed one thing, and that was where her money, her savings went first. That's it. Just their savings. She makes way more than 50 grand, but she just wanted to put where her savings went first. But then she's still a real estate investor, and she had started learning a lot about private lending. Just for the record, for anyone that's new here, for the record, every single one of those people, I think, and correct me if I'm wrong, that said they were making between 12 and 15% early on when we started this, I'll bet you 90 to 99% of them are making that return lending money just like the bank. So let me just hit this question from Sam real quick. He said, dividends are 2%. What does that depend on? Well, there's a lot of factors. So I don't want to get too in the weeds with it. Dividends, they range. And, we're at the lowest dividends that this insurance company I'm referring to has paid in the last 34 years, the lowest. So in the past, it's paid much higher dividends, but because of interest rate cycles, and that's so interest rates are one of the biggest things that play into dividends. Surplus, interest rates, returns of the insurance company. I mean, it's kind of just like, the dividend that you get from Apple, that's because they make money. And they pay a dividend, a stated dividend to the shareholders. So you understand how dividends are working in stocks. So in here with an insurance company, it's sort of just the return of the unused premiums that the insurance company didn't have to pay out in death benefits. So where the unused premiums, we call that surplus in the insurance world, those unused premiums also get invested, because insurance companies, much like banks, are very smart and they want their money earning something. So a lot of the money that they have in their surplus is lent out to big loans like skyscrapers, and banks need to buy a building, so they lend it to the bank. They put that money in US Treasury bonds, usually 30-year US Treasury bonds. So let me ask you this. When the Fed raises interest rates, what happens to the interest rate on 30-year Treasury bonds? Anyone thinking they go up? Absolutely correct. The yield on a 30-year Treasury bond goes up when the Fed raises interest rates. What else goes up when the Fed raises interest rates? All loan interest rates. So if the insurance companies with their surplus money, and their surplus money is just the premiums that they collected that they didn't have to pay out in death benefit, okay, and expenses, that money that's sitting there, they lend it out on big skyscrapers and big real estate deals, and they charge interest on that, right? So in a rising interest rate cycle, what happens to the interest they charge on the loans? It goes up, and they make more money, right? Right, the spread gets bigger. You guys are all starting to see the pattern. So what controls dividends? So if they're 2% today, what are they going to be in the future? I don't know. I can't tell you that because I can't predict the future. But if interest rates keep going up, chances are dividends will go up next, because that's a direct correlation. So not to get too far in, let's get back to this. This woman put $500,000 in this specially designed and engineered whole life insurance policy. And then she wants the ability to save 25 to 50,000 a year. So we'll just hone in on the 50. That's the max she can put into this policy by design. And because of that, she's going to buy a death benefit of just over $10 million. And all of you are like, wait a second, you said you put the lowest death benefit on. Hold on, I didn't tell you what makes up that $10 million, because about 7.6 million of this $10 million is term insurance. Dave Ramsey should be proud. It's actually, I think, a little more than that, but we'll get to that in a second. So about 7.6 million of the $10 million that this $500,000 dump in and the 50,000 she's going to put in a year buys $10 million on a 47-year-old healthy female. Not bad. If something ever happened to her, her family's going to be well taken care of. And also Dave Ramsey would be really proud of her, because the majority of this death benefit is in this cheap term insurance, 7.6+ million of that. So over here, her legacy right now, in terms of dollars and cents, her death benefit is $10 million. It's a little more, but let's just keep it simple. If she's going to be the bank, she knows that the number one thing she needs to do is move that money. She's got to make that money go earn a higher interest rate. Because I'm sorry, but if any of you are really excited about 5 or 6% interest, like we got a lot of work to do on you. It's just better than what the bank pays. Okay, but if you're excited about that, then you're really cutting yourself short. Earlier, you all said that you were excited about 12 to 15%, right? That's what you were excited about. You weren't excited about making 5 to 6. Matter of fact, if I said earlier, who's here is excited about making 5 to 6%, you'd all probably say, no way. That's not even as much. Inflation's more than that. Correct. So this person just wanted a better place to store her capital. and then look for an opportunity to lend or buy more real estate. So she's a real estate investor, and she goes out there and she goes onto this site called Private Money Club, and she finds a deal that's paying 12%. Now, hold on. I want to quickly transition over here, and I want to show you all something. So she goes onto this website right here, and she wants to look at the deals. Private Money Club is what this is called. And she goes on and she sees a bunch of deals. Now, offering 12%, offering 12, these are all the same person. So let me get down to somebody else. 12% first position, 25% for 6 months, 15% interest first position. So this is where she goes, and she finds a deal that she underwrites and decides is a good move for her, and she could just keep going. 10%. So you can see there's tons of them. 10%. Anyway, you get the drift. So when I'm saying 12 to 14% lending in a first secured position, I'm not making this stuff up. It's right there in front of you. You guys want a 12% first position deal? Boom, here's one. You can look at all the photos. You can go in and you can check the deal out. You can read the financials about it. You can, read the description. You can Google the property. You can even go over here in Private Money Club and do your own due diligence using software that's embedded in here. And if you're interested, you just go on, you say, hey, Bobby, I'm interested and I want some more information on this. I heard about this 12 to 14% and first secured position. Man, oh man, I watched Talladega Nights and he said, if you're not first, son, you're last. I want to be first, and Bobby's paying first. I'm not recommending or suggesting Bobby. I don't even know Bobby. I'm simply just, I picked the first deal. I don't know. But anyway, so this is just where she could go to find the interest rate. So back over here. So now she finds this deal of a real estate, and she's a real estate investor, so she understands real estate, where she can make 12%. So real quick, Stephen, can you do some quick math for me? Let's just say this lending deal in first secured position paying 12% needs $450,000. So how much would this particular client make on $450,000 if she lent it at 12%?
$54,000 annually.
$54,000 annually. Okay.
$4,500 a month.
$4,500 a month. So we all know the numbers. You guys can do the math yourself. It's a simple interest deal. If she had this money in a regular savings account, she could do the same thing. She could lend $450,000 over here. But if she puts the money in the whole life, she lends $450,000. But some of you mentioned earlier, one of the bad things is if I take $450,000 from this specially designed whole life, I got to take it as a loan. And I got to pay the insurance company interest. And the insurance companies right now charge between 4 and 6%. So let's just make it 5% for all intents and purposes, okay? Because that's right in the middle. About 5% interest that they're going to charge on $450,000. Now, for transparency and disclaimers, like depending on the insurance company, it could be a little more, it could be a little less. Depends on the company, and it depends on the time frame. This is 2023. I'm pretty darn close to what this company charges. It might be slightly more. So all I want you to do real quick is and in a second, I'm going to show you this mathematically, because listen, I can conceptually show you how this works, but I also want to show you the math behind it, because listen, some of you aren't going to believe me. Some of you don't even know me. I see some of the comments coming in and being like, nope, that doesn't work that way. Nope, nope, nope. But I'm going to just show you the math, because you might think I'm lying. You might think this is a scam. Your wife or your husband might think this is a scam, but you can't say math is a scam, because math doesn't lie. So she takes a $450,000 loan from the insurance company. Now, for those of you that understand this, you understand this, but for those of you who don't, if you put $500,000 in a bank account and you take $450,000 out, how much money's left? 50 grand, right? That's all what you're thinking. 500 minus 450, you'd have 50,000 left in your bank, correct? And if you were earning, let's just say 5.2% on that 50,000, that'd be a lot less than you'd be earning if you had 50 or 500,000 in there, right? Well, if you were earning 3% or 6% with a traditional bank and you had 500 grand in there earning 3 to 6%, that'd be good. But when you take the 450 out, you only have 50 in there earning that. That's not so good. You stopped the compounding interest on your money because you took it out to put it over here. But then you'd quantify that and say, yeah, but I'm making 12% over here. That's 54,000. Like, that's way better than making the 6. Everybody's with me, right? Imagine this, that the insurance company will allow you to take 450,000 of the 500 you put in, but you see the 450 that you take is a loan, but not a loan against your money. It's a loan against a future death benefit that they're going to pay out. So instead of taking 450 from your 500, what the insurance company is going to do is going to give you 450,000 of your death benefit, to use while you're living. And then the insurance company is going to use your 500 grand as collateral. But depending on the insurance company, as long as you use one like this, your 500, the cash value, is still earning interest and dividends. It's never, it's kind of hard to think. Like you put 500 in, you take 450, but you still have 500,000 earning interest and dividends. Well, yeah, it makes all the sense in the world because the insurance company isn't giving you your money. They're just using your money to collateralize a loan that they're going to give you from their surplus account because they're going to lend that money to you at an interest rate. And that's a profit center for the insurance company. So now the insurance company's dinging you twice. They're getting you on the cost of insurance, and now they're making interest on your money or your death benefit that they're lending you. But for any of you that are thinking, yeah, that sucks, stop. You seem to have forgotten that you still have 500,000 earning interest and dividends, and you now have $450,000 to use to lend out like this client at 12%, making $54,000 in interest for the year or $4,500 a month. Over here, if you're earning this interest rate and they're charging that, you're making a spread. And folks, that's a positive spread. That's pretty cool. Your bank account can't do this. Your brokerage account can't do this. No other account can do this. You're earning uninterrupted compound interest on all of your money, and you're still able to use that money to go out there and lend it to pay off debts, to buy stocks, to buy real estate, to buy cars, to buy boats, to invest in alternative investments, or hell, just to start your own company like I did with Private Money Club. Doesn't matter what you use it for. These are all opportunities. I just picked on lending. Now, the only reason somebody wouldn't lend money is because they don't know how to do that. We're going to tell you exactly how you do that. And we're not going to just tell you, we're going to walk you through it. We're going to hold your hand through it. We're going to tell you all the nuances about lending and borrowing on both sides. And we've got a special offer that we're going to get to in just a second on that. But let's finish this up. Earlier, when I asked you about the restaurant, and I asked you about the salon, and I asked you about the gym, and then I asked you about the bank, you all told me the same thing. If you borrowed money from your bank, this is your bank, you agreed that you would pay your bank back with interest. So here we go. The interest that you made is 12%, $4,500 a month. Where are you going to put that $4,500 every month? It's got to go somewhere. Well, some of you are like, well, I'm going to put it in the bank. Well, why would you put it in their bank when you just found a better bank and a better place to put your money where it earns a higher interest rate tax-free? Oh, yeah, I forgot about that. So wouldn't it just make sense to take the $4,500 a month that you're making on the 12% interest and just to put that money back into your bank? And wouldn't it also make sense that while you're putting the $4,500 back in, let's pay the loan down every month. So every month, $4,500 is being paid off of this $450,000 loan against your death benefit, which means every month, the insurance company that was charging you interest on that loan is making less because you're paying it down. And who controls every bit of that $4,500? You do. And how much money did you make? 12% plus a spread. And even if some of you are like just looking at the face value, you're like, well, 5.2 minus 5, that's barely anything. That's not even worth it. Right. Year one, year two, maybe you lose money too. Darn, you still made 12% here. Same thing. But you see, to give up interest for a couple of years, to make interest in a spread for the rest of your life, that's a small, small thing to exchange. But I want you to just look here, the circle, we just completed it. We put our money into a specially designed and engineered whole life. Why? Well, I gave you the reasons. It's private, it's guaranteed interest, it pays you dividends, it's tax-free if designed properly, it's protected against judgments and liens, and for crying out loud, it pays, in this case, $10 million to your beneficiary if you die. The only reason you wouldn't do this is if you don't care about your kids and you don't want them to have any money when you're gone. And if that's you, you're selfish. And you probably shouldn't be on this anyway. But I know that's none of you. So, and then when we make money, we just put the money back in our bank. You all agreed you were going to do this early on, and now I just showed you how to do it. But now let's put the numbers behind it, because this is where the rubber meets the road, folks. Because some of you are still like, oh, I get the concept, but man, I didn't have access to all my money in the first year, and I got to pay the insurance company interest. This is a product, okay? This is the whole life. And this is right off of an illustration that I have right over here. So I'm not making numbers up. Right here is the illustration. I just can't show this to you. So I did this because this is the actual client's illustration. But I just want you to know this is an illustration from one of the companies that we do. And I want you to also know that this is confidential, because this product design, I'm not going to tell you the company, and I'm going to show you the design, but you're not going to know how to do this yourself. This is proprietary to us at the Money Multiplier and Money School. That's right. No other agent, no other financial advisor can do this policy for you. None. Why? Well, because we've created it with the insurance company and we want it to be proprietary because we want to have something that nobody else can offer. It doesn't work for everybody. I want to be clear about that. So if somebody isn't dumping money in, this is not an option, but it's called the Rock. So let's go through the numbers here really quick. And I know there's a lot of numbers, so please don't get hung up on them and put questions in the Q&A because there's going to be questions. We already talked about how much this person is going to put in, $500,000 from the sale of a property. And every year, this person wanted the ability to put in $50,000 a year. Sorry, I gave you the exact numbers. It's $1 off. I'm sorry, I couldn't get it right at 50. They want the ability to put 50,000 and they want the ability to reduce that 50 down by half. So we did. We built it with a minimum of $24,324. So everybody's clear about that. This is the savings component of this policy. Over here is the cash value component. The client puts in $500,000 year one and has the ability to take at the end of the year when dividends are paid $458,133. But in that prior example, I showed her taking $450,000, which she could probably do immediately in the first 30 days, and then doing it into one of those private money club deals. And in doing that, she basically used about 90% of the money she put in because she didn't have access to all 500. She only had access to 458, which is roughly, she's giving up access to $41,867 in the first year. Now, some of you would say, oh, that's the reason I wouldn't do this. I would never want to give up the access to $41,867. Great, don't. Doesn't bother me at all. You know, there are people out there that they just can't live with the fact that you're going to give up access to a little bit of money. But stay with me for a sec. Remember when we lent that money out at 12%, you made $54,960? I don't know where the 960 came from. It's 54,960, I believe it was. See, we were short the first year by 41,000, but we made 54. So you actually made $11,000. You made money the first year and you still have a $10,672,030 death benefit. $10,672,030. Everybody understands that this death benefit right here, that's not free, right? Even if most of that is term insurance, you know that's not free. It costs money to have that. So what are we paying for in the first year? The death benefit. But you're not going to just pay for it the first year. The second year, you're going to put 50 grand in, and you're only going to have access to 37,000 in this plan design of the 50 you put in. Some of you are already checking out. Let's see. No, numbers didn't go down, but usually some people leave. 37,000 of the 50. You're like, well, that even sucks worse. That's $12,000 more that I didn't have access to. But hold on. Remember I said earlier, if we take 450,000 out and we lend it out, we're still making interest on $458,000. Remember that? And then if I put 50 in the second year, I'm still making interest on $495,000, even if I took all $495,000 out. I'm compounding interest uninterrupted because every year, like the first year, I took 450 out and I made 54 grand. The second year, I can take this 37 out and I can make 12% on that. The third year, I put 50 grand in. Oh, wait, what happened? The third year, I put 50 in and I can take $58,178 out. You see, now you've turned the corner, but it took you 3 years to get there. Well, it took you technically 2 years to get there. The third year, you turn the corner. Because the third year is the point where the cost for the death benefit is now going to be outweighed by the interest that you've been earning and the dividends you've been earning compounded. Okay, that's the most important year. You made 16% that year on the 50 grand you put in. The next year you put 50 in, you made 23%, 61,000. You put 50 in, you can take 61 out. How many of you want to put 50,000 in your bank account, come back at the end of the year and they give you 61,000 back that you can use? And if you take the 61,000 out, you're still earning interest on all of it. Anyone want that? How about the next year? You put 50 in and you take 64 out. All of you want this. And even when you take the money out, okay, you take 450 out, you take 37 out, you take 58 out, you take 61 out, you take 64 out, you send that money out to work, you take the interest and you put it back as a loan repayment. All we're doing is decreasing our death benefit by the amount that we took out because that's a loan against the death benefit. Now, for some of you that don't do the math that we do, because remember, if I'm putting money in and taking money out, what return do I care about? I care about the return I get on the money that I put in that year because the rest of the money's out working for me. So that's a hard thing for people to understand. They're like, I don't get that. If you had 500 grand, you put it in somewhere and you take 450 out and that money's out earning interest, all your money's moving. If you put 50,000 in and you take 50,000 out, most of you would earn zero interest. Hear me out. If you put 50 in and you took 50 out, most of you in a traditional bank, a brokerage account, you'd be making zero interest because you took all the money out. Here, you put 50 in and you're making interest on 58,000, even if you take the 58,000 out. This is the power of this. And this is why we use these stupid whole life policies. By the 6th year, some of you that are just doing the math, you're like 500 plus 100 plus 100. No, man, you're losing money. You haven't even broke even with what you put in. Yes, you did. 6 years. It took 6 years for the money that you put in to break even. But we never use that because that would only be applicable if you put the money in the policy and you never use the infinite banking policy. You never use private money club. You never paid off debt. You never bought cars. You never made that money go anywhere. You just left it in the policy. Then, yes, it would take you 6 years to break even and have more cash value than what you put in. And how bad does that suck, folks? Let's just look at the worst case scenario. Someone on here puts the money in the whole life, never uses the money for what we teach, which I'd be really upset with you. And then 6 years later, they have every penny that they put into that stupid whole life back. And every year there on out, after the 6th year, you're making money. Okay, you're ahead of the game. You're making more than what you're putting in cumulative. And the whole time you got $10 million in death benefit. Is anyone upset that you literally got all the money back for a $10 million policy? I mean, I don't know. I don't know how else to say it. And let me just go one step further and just show you how we do this. I normally don't show this, but this is the reason no one can do this. The base is that whole life insurance that all of you earlier said was really expensive. We put 10% of that 500,000 into the base in the first year. The second year, when we go to the 50, we increase it to 25%. And what that buys is $1.4 million in death benefit. So we technically, out of $10,672,000, $1,493 of that 10 million is true whole life death benefit. The rest of it is this term rider. No problem, Dave Ramsey. We got your back. 7.6 million went to a term rider because it was cheap. And we're going to keep that term rider on for 10 years. Why? Because the IRS has this thing called the MEX 7 pay rule that we're going to abide by. And we want this to be considered life insurance. So we're going to do this for a period of 7 to 10 years. We're going to keep this rider on. And that's going to give us a total death benefit, adding the two up, of $10,672,000. 90% of the money in the first year, that 500 grand, goes to the paid up additions rider. You guys can look that up, but this is early on where all your liquidity comes from. And then in the second year, we flip that to 75 to get 100. So we got 100% and 100%. This is how we design it. And because the way we design this, we build a policy like this that literally would be hard by any account for any other agent or any other financial advisor to beat our numbers. It's simply incredible. And I'm going to get to all the questions. So folks, if you have questions, I went over a lot of content there. We went over the product, which is a specially designed and engineered whole life. We went over the concept, the process, which is called the infinite banking concept. And we went over where you can earn those returns that people were talking about. Okay, so some of you are like, yeah, that's good, great, and fine, Chris, but I don't know how to be a private lender. I would be too risky. I don't know the first thing about it. Well, what if somebody could teach you and hold your hand through that? You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up. So Stephen, let me have you talk a little bit about this thing we worked on for 4 months that we just launched, and we're going to make available to every single person on here right now. All right. Sorry. Actually, just let's do the questions first. All right, let's get to the questions. So just real fast, Mike had 2 interesting things I just wanted to hit. He was asking, do you have any info on how you lend out the death benefit? So I asked him to clarify. So let's say you have $1 million in death benefit. I know one of the top producers of Lafayette is working with a private equity firm to take that death benefit and lend it out. Yep. In return, they pay about 4%. If insured dies, they pay the beneficiary. So I know exactly who that is. I know exactly how to do that. I just haven't done my due diligence on it, so I have not yet talked about it. It's a brand new thing. It's a private equity play where what they're doing is leveraging death benefit, kind of like what we did with Cap Factor, one of our private funds. We bought policies okay, from people that didn't want the policies anymore for the death benefit, because we know that they're going to die someday, and that when they die, we get the full death benefit to the fund, and that's how we make our return. But now what private equity companies are doing is something very similar, but they're working with the insurance companies to leverage that death benefit, and then they're paying people based on the death benefit. So I do have information on that if somebody was interested. And obviously Dave's doing it. I know a couple people doing it. It's just brand new. And just like everything else, I don't understand it fully yet. I don't like it because I don't understand it. So I need to know, like, and understand what I'm doing if I'm going to teach it. So I'm going to defer from that. Yes, that's available. Okay. And yes, I can help everybody with that. But please let me do the due diligence. Let me have our legal team do the due diligence, because the worst possible thing you could ever do is hear something from me where you get to leverage your death benefit, and then all of a sudden it comes out and it's another FTX or another thing that sounded too good to be true. We did it, and then all of a sudden we have a problem, and we can't, our death benefit that was supposed to go to our family doesn't go to our family anymore. So not trying to, say it's good or bad. I'm just not making an opinion on that.
Yeah, I hear you. And then using qualified money to buy a policy.
The only way to use qualified money to buy a policy is through a trust structure, a compound or a complex trust structure. It can be done. It's just complicated, and it's not going to be for everybody, which is why I don't talk about it, because it's pretty much better for high net worth individuals. So the average person with 50,000 in a 401k or an old IRA that wants to use that money to buy a policy, it's not going to make sense. The costs are going to exceed the viability of putting that money through that. So we got so whoever said that they're doing that, you all know, like, that's the person you want to call, because they probably have lots of money that they want to lend out because they're high net worth.
But yeah, I mean, I've never seen a way. So you can do SPIA and a 10-pay with qualified money.
Yeah, you can, instead of having to worry about MEC rules inside the corpus of a trust, if structured properly, and I preface that 10 times over, if structured properly, you could buy a single premium policy. So you could just this woman could take 500 grand and just put it into the trust corpus, buy a policy with that, and use qualified funds, because inside the trust corpus, you don't have to worry about MEC rules. And then also, then it could just be qualified funds as well. It's different rules. It's all in the IRS code.
Right.
Yep. You get a 1099 each year for the annual premium that you're putting in. I'm very aware of this. We just don't teach it.
Yeah.
It's complicated. We've gone to a bunch of tax attorneys about this, including the tax attorneys at Mass Mutual. And a lot of the tax attorneys do not like that. So if the attorneys don't like that, and I can't get attorneys to really, wholeheartedly all buy into it, I'm not teaching it. So good for you if you're using it. I know it works. I know it can be done properly. If you've got the blessing from your attorney, God bless you, then it's just got to be done right. And there's a lot of things people can do that will make mistakes, and then all that money can become taxable or have additional problems. So I have just avoided it, because I'm trying to help more people solve more problems. I'm not just trying to help just high net worth individuals solve some problems. But Mike, thanks for bringing that up. It is an option for some people.
So as far as how we can help, is with the, lending the money and doing everything the right way, what we've done is we've developed an accelerator coaching program, and I'll just share my screen here. So this is our Private Money Club 8-week accelerator coaching program. This can be done as a borrower or a lender. So they are going to be separate courses that focus on one or the other. Now, there will be some overlap because there's a lot of mindset that goes into thinking like the other. So like if I'm borrowing money, I immediately want to start thinking like a lender. How can I, as a borrower, make this deal look better? How can I reduce risk, which would allow me to pay less interest out, presumably? You're going to have that risk reward at all times. How to present the deal in a manner that makes sense. And this will be applicable for not only deals within Private Money Club and our community, but what we teach will be able to be used in the real world as well, so to say. So if you are borrowing money from multiple sources, maybe you work with friends or family, maybe you attend RIAs or meetups around your local area, networking events. Maybe you're just in Private Money Club for all your borrowing needs. But what we're going to teach you with this program, the borrower program, is going to be relevant for all of that. And then on the lender side, obviously, that's very, 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 very important to understand how this works, because, this is your hard-earned money. And the number one rule when it comes to Private Money Club and private money lending is protecting your wealth. That's what we're going to focus on completely. So in this 8-week program, the focus on is not only how you evaluate who you're lending your money to, how do you evaluate the deal that you're looking at and underwrite for it to make sense? What parameters are you working in? What specifics? But we're also going to get into, what are some little things that you can do, little tips and tricks that we've learned over the years and years and years of doing this that are going to help you in the long run. So if the worst case scenario does occur, how do you protect yourself and your money completely without fail? And there's little things that you can do to make sure that happens. And even if a deal goes bad, how you can have the person actually, use their other assets to make you whole and things of that nature. So we are specifying this for a lender or borrower. This class is going to start here in a couple weeks. We've had so much demand for it. I will say we've had a bunch of people enroll for it after the 3-day training this weekend. So it's starting to fill up. So if you're interested in this, the sooner the better, because we want to keep it relatively small, like 10 to 12 people per group for this first one. So I'll share this page. It's moneyclub.com/accelerator. But basically, you can go on here. You can just learn a little bit more about it. So the breakout of what it's going to look like. Let me see. The first 4 weeks are going to be weekly Zooms. So the lender class is going to be on Wednesdays at 6 p.m. Eastern. It's fully recorded. We give you the recordings, whether you're there or not. You can keep the recordings, refer back to them at all times. But it will be every Wednesday for the lender course at 6 p.m. Eastern. And that's going to be starting March the 6th. So week 1, we're going to start looking into what to look for in a borrower and their team, starting to talk about risk assessments and what rate to charge. So that whole risk versus reward. Week 2, mindset of a successful borrower and lender, understanding the other side, different critical documents. Week 3, establishing a business model, understanding rules, what to say, what not to say, building an elevator pitch, leveraging all the resources and everything that you have available to you as a PMC member. So just some of the different topics we're going to be hitting on. There is an investment for this in 1997. We're going to give you some bonuses. So number 1, if you are a premier member in Private Money Club, at the completion of this accelerator course, you're going to get a badge on your profile announcing you as a accelerator coaching graduate. And all that's doing is building credibility, because if I'm on Private Money Club and I'm looking for a borrower or I'm looking for a lender, who that person is matters a lot. So if I see somebody that just hasn't really done anything, I don't know who they are, and I have somebody else that has a coaching badge, they've been to live workshops, they, attend our trainings, that person I know is educated, I'm going to want to work with that person. So we're going to give you a badge just to kind of put you on that pedestal and set you apart from the others. We're also going to announce you on Money Club Mondays and introduce you to the entire community. So again, building your credibility and showing everybody else in the group that you're serious about your real estate or your lending business, your entrepreneurial business. So just some of the different things that we're going to do with you, just some more stuff that you're going to learn. If you want to learn more details, obviously load in. This class is going to be taught by my friend Noah Harris. I've known Noah for almost 15 years. We've trained with some of the same people. Noah and his wife live in Columbia, South Carolina, and they're absolute rock stars. They've been borrowing money for almost 10 years now. They've dealt with quite a few different borrowers from outside Private Money Club, inside Private Money Club. Personally, my family's lent to Noah and his wife, and they are just very good educators. They've also been coaching and training for many years. So they're very, very good at communication. And I'm super excited for you guys to meet Noah if you haven't already. We've had him on some Money Club Mondays and some trainings. He'll be on this Thursday with me. By the way, this Thursday is our 2-hour group coaching that's free for all Premier members. So if you're a Private Money Club Premier member, make sure you join us this Thursday at 6 p.m. Eastern. And Noah and I have 2 hours of really solid training planned for you. And then we're going to roll it right into the 4 weeks of training starting in March. So you can learn a little bit about Noah. The borrower program, very similar. We have it broken down exactly what you're going to be learning, 7 steps to building credibility, and kind of what all this looks like, mastering one-on-one meetings, both in person on PMC. I can run right through this, but I think you guys kind of get the idea. So very, very important stuff to not only put you on that pedestal, but also understand, make sure you understand exactly what you're doing to protect you and your investors' money. Because I got to say this as a borrower, I mean, if you have one deal go bad and you lost some people's money and things weren't set up properly and you didn't take care of it and communicate it the right way, your entire real estate business could be done. Like, where do you go from there? But if you even if a deal goes bad though, and you have things set up the right way and you have different strategies in place that we're going to teach you, you know, you can get out of a bad deal without it completely destroying you, your reputation, and your business. So it's all about just having things set up properly, but they got to be set up properly from the start. It's not something you can scramble later on and do. So this stuff's so very important before you start learning or before you start lending and borrowing to get this stuff in place. And we're building this whole thing on 3 different pillars. So just so you know, the overall program, and I'll end on this, Chris, but you know, the whole idea of this is to give you the confidence, the credibility, and the clarity to be able to build whatever it is that you're building. If you're lending to just grow your wealth through that income coming in from these loans, if you're growing your real estate business, borrowing money the right way and just snowballing that, you know, getting those lenders where they love working with you. So as soon as you pay them back money on one deal, they're begging you to write another check to you for the next deal and the next deal. And that's how you start getting multiple deals going. And that's how you start growing. But it starts with that confidence, being able to share that confidence in a credible way and being able to be very clear about what your vision is, what that looks like, and what that success looks like, not only for you, but also for the person lending you that money or borrowing that money. And if we can all get on the same page, it's going to be a beautiful thing. So I'm super excited for this class. And the lender program starts March the 3rd, just so you guys know. That one's on Mondays. So the borrowers on Wednesdays, the lending programs on Mondays, and we'll get them going concurrently. And again, you'll just pick which course that you want to be in.
Yeah, I love it, Stephen. I mean, we worked really hard with Noah in picking, you know, who was going to help Stephen run this and help us get this off the ground. But the biggest problem we had with Private Money Club is people saying, I don't really know what to do. I don't know how to protect myself. I don't know the steps to take. And this came from both sides. You know, we had borrowers that were newer borrowers and they didn't know how to really be a good borrower. They didn't know how to prepare their deals. They didn't know how to work with private lenders. So that's that section. So we created this from scratch, folks. None of this is regurgitated. It is brand new coaching material. And then the same thing on the lending, which is very comprehensive about everything we've done. And we've lent money on so many deals. We've got all that data and we basically just said, here's the best path. And we just walk you through it. And then we give you all the support and all the resources. And there's also some people are asking, you know, that they were already a member of Private Money Club. They're like, oh, is there any discounts for members? Yes. So if you're an existing Premier member, it's $500 off, and we'll give you the coupon code for that. But outside of that, it's $19.97, whether you're a lender or a borrower. We have lots of people doing the lending and the borrowing. So they're just bundling it together and doing both. But I did want to let all of you know that, you know, if you're a member already, we wanted to reward you for being a member. We wanted to thank you for being a member. So we did discount, you know, whatever training you want, you know, by $500 to help you out. You know, when we first started, everybody wanted, you know, those returns that people were posting, the 14 and the 15 and, you know, those kind of percentages. And you all love the idea of having it secured. Well, that's how you do it, folks. You be the bank. You do what the banks do. You lend money the way the banks do, and you protect yourself the way the banks do, because the banks are always in a secured position, and you all have the ability to do it. Here's the dates for the next class.
Sorry, I might have had those backwards, so I just wanted to clarify. Yeah, the borrower coaching's on Mondays, the lending coaching's on Wednesdays, and those will be the 4 weeks. And I guess the one thing I failed to mention was the 4 weeks of coaching weekly Zooms. The next 4 weeks is coaching implementing what you're doing. So each week we're going to give you homework to be ready for the next week and to build up. So as soon as you graduate these 4 weeks, you're ready to either get money for your first deal and have that set up, or you're ready to lend money. And then we'll spend the next 4 weeks with you on weekly calls, as well as through the Slack channel. That's only for coaching members. It's only coaching people that are in your class on the Slack channel. And we'll be able to share things together, and we'll hold your hand through doing that first deal over those next 4 weeks to make sure you're doing it the right way. Any questions you have whatsoever. So we're going to teach you, and then we're going to hold your hand to support you to make sure you get that first deal done. So that's what that looks like the next 4 weeks, because it is an 8-week program, just to clarify.
Yeah, I don't know. I always say 4 weeks, so I always missay that, but it's 8 weeks.
Yeah, me
And
too.
also too, for any of you that were kind of watching that training we just did on the whole life policy, and some of you are like, well, how do I set one of those up? The coaching is great, but how do I set that up? I just put a link in the chat right there for how to do that, or you can always email or just jump right on Steven's calendar if he puts it up there. So what I did is I gave you some other links for like a 90-minute video we have and some other stuff. So there's essentially two different things you can do from today's training. You can do the Private Money Club Accelerator Coaching Program, which is just one of the greatest things we've created in quite some time since we created Private Money Club. And the second thing you can do is you can basically get one of these policies set up for you. So you can do it just like that client is, and just like anyone else on here that you saw posting some of those returns. Many of them were doing it exactly how I just showed. So, you know, again, there's the links up there for you to do either one of those. And then how much is it to join Private Money Club? So if you were to join Private Money Club, it's $14.97 a year. That's going to be the cost of it. So if you're looking to join Private Money Club and do the lending or borrowing coaching program, the accelerator, basically what you want to do is you want to email Steven, which he's put his link up right there. So if you're interested in both, like you want the Private Money Club community, you want to be in Private Money Club, which obviously makes sense, and you want the coaching, we have a bundle. It's just different than what we just showed because we just showed just the coaching. And the best thing to do is just right there, set up a call with Steven on his link that he put up. So you just got to scroll up a little bit, Steven. It's a go.once hub. Set up a call with him, and then he'll show you how to get that done. So we haven't left anything out. You know, we've really covered this in the most comprehensive way. And you're going to start hearing a lot more about this because you know what? Like I said earlier, and like Steven said, we didn't just create this to create this. We created this because everyone was asking for it. And we actually felt stupid. We're like, damn, I guess we just assumed everybody knows how to be the bank and everybody knows how to do lending. And we were wrong. And we had to create a program that was comprehensive and detailed enough to really allow someone to literally have to get done with the 8-week accelerator program and jump right into Private Money Club and start doing it. Or the best way to learn is as you're going through the accelerator different the weeks, you go on Private Money Club right after and you start applying the knowledge you learned. Think about that. In college or in high school, how did you learn the best? You will learn by applying the knowledge. That's what this is designed for. It's a two-step thing. You got the platform where all the deals are, where those returns are. And then you got the knowledge through the coaching and the hand-holding that Noah will do. You just blend the two, and all of a sudden now you're off to a really fast start. And then, you know, a lot of people were asking, you know, they saw the comments from Mike, you know, in regards to leveraging death benefit. I know all about this. Okay. I know the guy he's talking about from Lafayette. We actually, me and Steven, we had some cocktails with the guy. He's a great guy, you know, but it's brand new. And I urge all of you in these times, I can tell you time and time again, people make mistakes because they jump too soon. They think it sounds so good. They're just like, oh my God, how do I do that? Just pause. It's not going anywhere, but let us do the due diligence on it for you because we know the people at the insurance companies very well, right up to the president. We sat last year poolside with the president of Lafayette Life. We also sit poolside with the president of One America and all these companies. We're at the top level. We can just ask the president, hey, I heard about this thing that's being done. Like, what do you guys think about it? Have you run this through legal? Is this something you guys are okay with? And they're like, oh, well, no, that's why we're not talking about it. Then I'm not going to teach you about it. And then proceed at your own risk. So we're really cautious these days about what we teach. We want to make sure we give you the right information. We don't want to just chase fast, unrealistic returns because then you violate the fourth law of wealth, which is when you seek unrealistic returns, your money will flee you. Now, you're probably thinking, well, it's my death benefit. I don't really care. Still, your family will. And you know what? Just this week alone, we had one death benefit that Steven's going to be delivering. The guy was, how old was he, Steven? 50s? 60s?
Just turned 60, like 60, 61, yeah.
Just turned 60 years old, folks. Many of you on here are 60. And he passed away unexpectedly. His death benefit is going to really be an unbelievable windfall of money for his family to continue their lifestyle. Just today. And I want to, listen, I try not to get into this, but it just seems to be happening more and more lately. We've had several death claims lately. Just today, one of our great clients, one of Gabby's clients, gave her a call, pretty upset, and he came down with a terminal illness, okay, cancer. You all have probably seen that. And because he's got a policy with us that he uses for the infinite banking concept, there's living benefits. He's going to be able to access his death benefit once he's approved by the insurance company, because terminal means you've only got X amount of time to live. The insurance companies, through this living benefit, will give him access to that death benefit while he's living. So he can spend, it's sad to say, but his final time on this earth with the people he loves, doing the things that they want to do. And he won't have to worry about money, and how he's going to pay for that Disney trip or that vacation, because the death benefit is going to be able to be used while he's living to enjoy his time. So whether that's something that hits home with you or not, doesn't matter. These are two things that have happened in the last 2 weeks for us here. So when everybody's like, oh, that death benefit, just stop. Because when you're taking your last breath, it will be so vitally important that you take care of your loved ones that you will never even you won't even be thinking about the infinite banking concept. You'll be thinking about the planning, which was secondary, and it was that death benefit at that time. So folks, what we do is so vitally important. We solve really big problems. We solve problems while you're living, but we also solve problems when you're no longer here. And let's not forget the importance of why we use whole life insurance. It is a promise. It is a promise that when you're gone, your family and your loved ones and your beneficiaries will be taken care of with a tax-free death benefit. And while you're living, hell, it's pretty cool to see how that money works, the uninterrupted compound interest and all that. But let's just really focus on both sides of that, because equally, they're just as important. With that being said, folks, we really appreciate your time today. We hope this was really beneficial, and we hope you learned something. And I'm certain of it. We will see a bunch of you in the Accelerator Coaching Program. With that being said, thank you for joining us for another wealth webinar. We'll see you next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.